Good evening. We begin tonight with a significant development in global financial markets that has captured the attention of investors, traders, and economic analysts worldwide. Silver prices experienced a dramatic surge today, climbing approximately 7% in a single trading session. This sharp upward movement represents one of the most substantial single-day gains for the precious metal in recent months and has reignited discussions about the future trajectory of silver valuations in the commodity markets. The sudden price increase comes at a time when precious metals have been under intense scrutiny from market participants, attempting to gauge the direction of various asset classes amid a complex global economic landscape. Silver, often referred to as the poor man's gold due to its lower price point compared to its more famous counterpart, has historically exhibited volatility that can exceed that of gold, making it both an attractive and potentially risky investment vehicle for those seeking exposure to precious metals. Today's 7% jump in silver prices has prompted widespread speculation about whether this movement represents the beginning of a more sustained rally or merely a temporary spike driven by short-term market dynamics. The magnitude of the gain is particularly noteworthy given that silver has experienced periods of relative stagnation and price compression in previous trading sessions, leading some market observers to wonder if the precious metal had been coiling for a significant breakout. Financial markets have witnessed considerable turbulence across multiple asset classes in recent periods, with investors navigating a landscape marked by shifting monetary policies, geopolitical tensions, and evolving economic indicators. Within this context, precious metals like silver and gold have traditionally served as safe haven assets, offering investors a potential hedge against currency devaluation, inflation, and broader market instability. The sudden surge in silver prices today suggests that market participants may be reassessing their risk exposure and seeking alternative stores of value. The question now circulating among investment professionals and market commentators is whether silver is positioned to reach the psychologically significant $100 per ounce level in the year 2026. Such a price target would represent a substantial increase from current levels and would mark a historic milestone for the white metal, which has not traded at such elevated valuations in its modern trading history. The speculation about a potential move to $100 per ounce has generated considerable interest and debate within the investment community. Silver's industrial applications distinguish it from gold in important ways that can influence its price dynamics. While gold is primarily used for jewelry and investment purposes, silver plays a crucial role in numerous industrial processes and technological applications. The metal is essential in the production of solar panels, electronic components, medical devices, and various other products that form the backbone of modern industrial economies. This dual nature of silver, serving both as a precious metal investment and an industrial commodity, creates unique supply and demand dynamics that can contribute to price volatility. The surge witnessed today has been characterized by some market observers as shocking, a term that reflects both the magnitude of the price movement and the speed with which it occurred. In commodity markets, where price changes typically unfold gradually over extended periods, a 7% single-day gain represents a significant departure from normal trading patterns. Such movements often prompt questions about the underlying catalysts driving the price action and whether fundamental factors support the new price level, or if technical factors and speculative positioning are primarily responsible. Market participants are now analyzing various factors that may have contributed to today's dramatic price increase. These factors can include changes in supply and demand fundamentals, shifts in investor sentiment, technical chart patterns triggering automated trading systems, short covering by traders who had bet against silver prices, and broader macroeconomic developments that influence commodity markets. Understanding which of these elements played the most significant role in today's surge is crucial for assessing whether the price gains can be sustained in subsequent trading sessions. The concept of a rebound in silver prices implies that the metal had previously experienced a decline or period of weakness from which it is now recovering. Price rebounds in commodity markets can occur for numerous reasons and can vary significantly in their durability and strength. Some rebounds represent temporary relief rallies within longer-term downtrends, while others mark genuine turning points that lead to sustained price appreciation. Determining which category today's surge falls into requires careful examination of both technical price patterns and fundamental market conditions. Silver has historically exhibited a tendency to experience sharp price movements in relatively compressed timeframes. This characteristic volatility stems from several factors, including the relatively smaller size of the silver market compared to other commodities, the concentration of production among a limited number of mining operations, and the metal's sensitivity to both investment demand and industrial consumption patterns. When these various forces align in a particular direction, silver prices can move dramatically, creating opportunities and risks for market participants. The mention of the year 2026 as a potential time frame for silver to reach $100 per ounce suggests that some market analysts are developing medium-term price projections based on anticipated developments in supply, demand, and broader economic conditions. Price forecasting in commodity markets is inherently challenging, as it requires making assumptions about numerous variables that are subject to change. Nevertheless, such forecasts can provide a framework for understanding the potential trajectory of prices if certain conditions materialize. Investment in silver can take various forms, ranging from physical ownership of coins and bars to exchange-traded funds that track silver prices, mining company stocks, and futures contracts. Each of these investment vehicles offers different risk-reward profiles and suits different types of investors with varying goals and time horizons. The sudden surge in silver prices today likely affected all of these investment categories, with physical silver, silver-backed funds, and mining stocks potentially experiencing corresponding gains. The industrial demand component of silver consumption adds an element to price analysis that differs from purely monetary metals like gold. Economic growth, technological innovation, and shifts in manufacturing patterns all influence the quantity of silver required by industrial users. In recent years, the expansion of solar energy installations has emerged as a particularly significant source of silver demand, as photovoltaic panels require silver for their electrical conductivity properties. Changes in the pace of solar panel deployment can therefore have meaningful impacts on overall silver demand. Supply dynamics in the silver market involve both primary production from dedicated silver mines and secondary production from mining operations that extract silver as a byproduct of other metal production, particularly lead, zinc, and copper mining. This complex supply structure means that silver production levels are influenced not only by silver prices themselves, but also by the economics of these other base metal mining operations. Understanding these interconnected relationships is important for assessing how supply might respond to changing price levels. The psychological impact of today's 7% surge should not be underestimated in terms of its potential influence on future trading activity. Large price movements can attract attention from investors who had not previously been focused on a particular asset, potentially bringing new capital into the market. Additionally, dramatic gains can influence the sentiment and positioning of existing market participants, causing traders to reassess their strategies and potentially reinforcing upward price momentum through positive feedback loops. Technical analysis, which involves studying price charts and trading patterns to forecast future price movements, likely played a role in today's surge. Silver may have broken through key resistance levels that technical traders monitor closely, triggering buy orders from traders who use chart-based signals to guide their decisions. Such technical breakouts can become self-fulfilling prophecies in the short term, as the act of breaking through a widely watched price level generates buying activity that further propels prices higher. The relationship between silver and gold prices is another important consideration for understanding today's movement. The gold-to-silver ratio, which measures how many ounces of silver are required to purchase 1 ounce of gold, is a metric closely watched by precious metals investors. Historical patterns in this ratio can provide insights into whether silver is relatively cheap or expensive compared to gold at any given time. Changes in this ratio can indicate shifting preferences among precious metals investors and can signal potential price movements in one metal or the other. Currency markets also play a significant role in precious metals pricing, as gold and silver are typically denominated in United States dollars in international trading. Fluctuations in the value of the dollar relative to other major currencies can influence the attractiveness of dollar-denominated commodities to international buyers and can therefore affect demand and pricing. A weaker dollar generally makes commodities less expensive for holders of other currencies, potentially stimulating demand and supporting higher prices. Central bank policies regarding interest rates and monetary expansion have historically shown strong correlations with precious metals prices. When interest rates are low, the opportunity cost of holding non-yielding assets like silver and gold decreases, making these metals more attractive to investors. Conversely, when interest rates rise, income-generating assets become more competitive, potentially reducing demand for precious metals. Today's surge in silver prices may reflect market expectations about future monetary policy directions. Mining companies that produce silver are likely to see their business prospects influenced by today's price surge. Higher silver prices can improve the profitability of existing operations and may make previously marginal deposits economically viable to develop. However, mining companies face various operational challenges and cost structures that mean share prices do not always move in perfect correlation with the underlying commodity price. Investors interested in gaining exposure to silver through mining stocks must consider these company-specific factors. The global nature of commodity markets means that developments in different geographical regions can all contribute to price movements. Production disruptions at major mining operations, changes in consumption patterns in large industrial economies, regulatory developments affecting mining or industrial use, and geopolitical events that influence trade flows can all play roles in determining commodity prices. Today's surge in silver may reflect the combined influence of multiple factors originating from different parts of the world. Speculation about silver reaching $100 per ounce represents a price level that would more than double or triple current trading ranges, depending on the specific price from which such a rally would originate. Such substantial price appreciation would typically require a combination of strong fundamental drivers, including robust investment demand, healthy industrial consumption, and potentially supply constraints that create a shortage situation in physical markets. Whether all of these conditions can align to support such elevated prices remains a subject of debate. Historical precedent provides some context for evaluating the feasibility of dramatic silver price increases. The metal has experienced significant bull markets in the past, most notably in the early 1980s, when prices briefly exceeded $50 per ounce, and again in 2011, when prices approached that level once more. These historical episodes involved specific circumstances, including high inflation, geopolitical tensions, and concentrated speculative positioning that drove prices to unsustainable levels, from which they subsequently declined sharply. Risk management considerations are paramount for investors contemplating increased exposure to silver following today's surge. The same volatility that can generate substantial gains can also produce significant losses if prices reverse direction. Prudent investment practice typically involves position sizing appropriate to one's risk tolerance, diversification across multiple asset classes, and careful consideration of one's investment time horizon. Chasing sharp price movements without understanding the underlying drivers can expose investors to considerable downside risk. Market liquidity in silver trading can vary significantly, depending on the specific instrument and trading venue. Physical silver markets operate differently from futures markets, which in turn differ from equity markets for mining companies. Understanding the liquidity characteristics of different silver investment vehicles is important for investors, as liquidity affects the ease with which positions can be entered or exited and can influence the transaction costs associated with trading. The characterization of today's movement as shocking suggests an element of surprise among market participants, indicating that the surge may not have been widely anticipated. Unexpected price movements can result from information asymmetries, where some market participants possess or react to information before it becomes widely known, or from technical market dynamics, such as stop-loss triggers and forced liquidation, that can amplify price movements beyond what fundamental factors alone might suggest. Looking at the broader precious metals complex, silver's movement today likely occurred within the context of price action in gold, platinum, palladium, and other related assets. Correlations between these metals can vary over time, but they often move in similar directions due to shared fundamental drivers. Understanding whether today's silver surge occurred in isolation or as part of a broader rally in precious metals provides important context for interpreting the significance of the price movement. Investor positioning data, when available, can offer insights into market dynamics and potential future price movements. If today's surge occurred while speculative traders held large short positions in silver, the price increase may have triggered short covering that amplified the upward movement. Conversely, if speculative long positions were already elevated, the sustainability of further gains might be more questionable. Understanding the positioning landscape can help assess the technical backdrop for prices. The physical silver market involves various participants, including refiners, fabricators, dealers, and end users in industrial applications. The interaction between these physical market participants and financial market traders can create complex dynamics. Physical market tightness, evidenced by delivery delays, rising premiums for physical metal over futures prices, or inventory drawdowns can signal genuine supply-demand imbalances that support higher prices. Today's surge may or may not be associated with such physical market developments. Media coverage and public attention surrounding commodity price movements can themselves become factors influencing subsequent price action. Dramatic price surges generate headlines that attract attention from investors who might not regularly follow commodity markets. This attention can bring new participants into the market, potentially providing additional buying pressure that extends price rallies. The self-reinforcing nature of such dynamics means that price movements and media coverage can interact in complex ways. Today's 7% surge in silver prices represents a development of significant interest to a wide range of market participants. Whether this movement marks the beginning of a sustained rally that could eventually take silver to $100 per ounce in 2026, or merely represents a temporary spike that will be followed by consolidation or reversal, remains to be determined through subsequent price action and fundamental developments. The coming trading sessions will provide important information as markets digest today's movement and as participants assess the strength of underlying support for current price levels.